This is a learning and exam preparation video for the IB Business syllabus. At the end of the video are practice assignments for you to prepare you from the exams. Please click www.intmace.com on the link at the bottom of this video to do the assignments for this topic.
Unit 3.5 Profitability and Liquidity Ratio Analysis. Ratio analysis. It is a financial tool used in the interpretation and assessment of a firm's financial statements. It helps in evaluating the firm's financial performance by determining a certain trend and exposing its various strengths and weaknesses. It aids in decision-making by making meaningful, historical and inter-firm comparisons through analyzing past ratios and ratios of other businesses in the same or different industries. Profitability ratios. These ratios assess the performance of a firm in terms of its profit-generating ability. The two types of profitability ratio are gross profit margin, GPM, and net profit margin, NPM. Gross profit margin, GPM. This is found by dividing the gross profit by the sales revenue, expressed as a percentage. GPM equals gross profit over sales revenue times 100. Strategies to improve GPM. A firm might increase prices for products in less competitive markets or markets where consumers are less sensitive to price changes. This may lead to increase in sales revenue because the quantity purchased may not change significantly with changes in price. A business might source cheaper suppliers of materials so as to cut down on these purchase costs, and will help in reducing the cost of sales and help increase the GPM. A firm might adopt more aggressive promotional strategies that will persuade the customers to buy its product. A business might aim to reduce direct labor costs by ensuring that its staff are more productive or are able to sell more units of the goods produced. Net profit margin, NPM. This is a measure of profit that remains after deducting all costs from the sales revenue. It is calculated by dividing the profit before interest and tax by the sales revenue, expressed as a percentage. NPM equals net profit before interest and tax over sales revenue times 100. Strategies to improve NPM. A firm can carefully check on the indirect costs to see where unnecessary expenses may be avoided, for instance by reducing expenditure on expensive holiday packages for senior managers. A firm could negotiate with key stakeholders with the aim to cut costs, like asking suppliers for product discount. Efficiency ratio. These ratios assess how well a firm internally utilizes its assets and liabilities and also analyze the performance of a firm. One example of efficiency ratio is return on capital employed, ROCE, ratio. Return on capital employed, ROCE. These ratio measures both the efficiency and profitability of a firm's invested capital. These assess the returns of a firm is making from its capital employed. Capital employed is found by adding a firm's long-term liabilities, loan capital, to its share capital and also to its retained profit. Capital employee equals long-term liabilities plus share capital plus retained profit. ROCE equals net profit before interest and tax over capital employed times 100. Strategies to improve ROCE. A firm should try to reduce the amount of loan capital while still ensuring that net profit remains unchanged or does not fall. A firm might declare and pay additional dividends to shareholders. This will have the effect of reducing the retained profit, and hence raising the ROCE, assuming net profits remains unchanged or does not decrease. Liquidity ratio. These ratios measure the ability of a firm to pay off its short-term debt obligations. Liquidity is a measure of how quickly an asset can be converted into cash. The two important liquidity ratios are the current ratio and the acid test ratio. Current ratio. This ratio makes a comparison of a firm's current assets to its current liabilities. A firm might reduce bank overdrafts and choose instead to seek long-term loans. It will help in reducing current liabilities and hence improve the current ratio. Another strategy would be selling existing long-term assets for cash to increase the available working capital for the business. Current ratio equals current assets divided by current liabilities. Strategies to improve current ratio. A firm might reduce bank overdrafts and choose instead to seek long-term loans. This helps to reduce current liabilities and hence improve the current ratio. Selling existing long-term assets for cash. This increased the available working capital for the business. Acid test ratio. This is a more stringent indicator of how well a firm is able to meet its short-term obligations. Acid test ratio equals current assets minus stock over current liabilities. Strategies to improve acid test ratio. A firm could sell off stock at a discount for cash. It will help improve the liquidity position of the business and avail more working capital to pay off its short-term debts. A firm might increase the credit period for debtors to purchase more stock on credit.
Practice assignments, exam prep assignments for the IBA Business Studies syllabus. You may now proceed to try out the exam preparation assignments. All assignments will be marked and feedback will be given. Should you need to speak to one of our tutors, send your email to administration@intmace.com. Please proceed to the link www.intmace.com at the bottom of this video to commence with your practice. Please click subscribe to our video if you find the content useful. All the best with your assignments.